Okay, good afternoon. Welcome to Weekly Take on the Market. Today is Friday, September 5th. It's about 12 o'clock Pacific Standard Time. I will be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. Everything I give you will not be construed as buy, sell, or hold ideas. All right, so we'll go through the indices. We'll do good trade, bad trade. We'll do stocks to watch, and then the quote of the week. Pretty much the usual routine. Okay, so we are in a seasonally weak period. I didn't realize that August was slightly negative as well. I thought September was the only month that was slightly negative. It could be maybe if you use the Dow. Going back even further, this is the S&P from 64 to 2015. I apologize. But when I just did a Google search and screen grabbed this, and so I didn't even realize it was only to 2015. But you get the idea. So September is seasonally weak. What does that mean? I don't know what it means. If you want to use it, great. If you don't want to use it, great. I'm indifferent to it. I think there is something to seasonality. I just don't know how you can use it effectively. You can see just I've had some of my best years with the months of January and December. I think the best month I ever had was January of 2000. If I recall correctly, I didn't keep as good records back then as I do now. I could go in now and in the last 15 years, I could find the best month I've ever had. It could just be random noise, but I do know that at O'Neill and Company on the portfolio management side, when I was there, they kept stats like that, and their best month was December. So I think there's something to it. I really do. And so hopefully we get some type of consolidation here and it sets you up for the last quarter of the year, which is normally pretty good. That would be awesome. So I would love to see the S&P go down. In fact, I'd love to see it go down a lot in in this month, but I can't force it down. Unfortunately, I've tried to before and it didn't quite work. So I'll just play the cards as I get them. I might not be as aggressive knowing this kind of seasonality, but like today, for example, the market gapped up. I'm not going to be an aggressive buyer, and normally I probably wouldn't matter anyways. If it's January, February, March, I'm normally not going to buy a gap up like that. But I will do a little bit more selling maybe if I'm thinking about the month being seasonally weak. I don't know. This is all stuff that I think about, but then in the end, sometimes it's a little bit seat of the pants, and I just kind of trust my intuition on what I think is going to happen, and I go with it. I do much better when I'm just looking at the stocks that I own, the stocks that I wish I owned. So that's kind of my sweet spot. This is what it looks like on a chart. It's kind of cool. I like this chart, so you can see kind of if you uh, invested in a 20-year range ending in 2022. So see how September can be a sharp break, but then off the lows in September can be very lucrative. So let's hope that that's how it plays out. Bull bears, AAII sentiment, still more bears than bulls. Maybe it's just broken. I don't know what to make of this index. In fact, I almost didn't even put it on here. I hadn't looked at it in a couple of weeks, and I was filling out the PowerPoint, and I thought, oh, what about sentiment? I was like, I don't know. So this is a lot like seasonality. Some people will tell you it's a waste of time. Some people swear by it. It's probably somewhere in between. Okay, so let's go to the indexes. I'm going to turn my camera off so you can see the charts better. And here's the S&P. So it got a bit of a reversal today, though. One thing I'll tell you about the market is like, it just doesn't like to go down. And that's a weird statement, but like, you had a really bad break this morning, and it just stops. You see what I mean? How you have this bad break and it just stops. This one worked for 2 or 3 bars, but then it's stopped. You could see how they just do not like for the market to go down. And this is 60-minute um, chart, so I just don't think there's any point in being bearish until it goes down and then stays down and then goes down and then stays down. So maybe you could be less bullish if you want. I don't have a problem with that, but it's just hard to be bearish. I think we're kind of in this channel, and until we break below it and stay there, I just don't have any desire to be bearish. Doesn't mean I won't short something here and there, but to be, outright bearish. So, and then if you look at like a weekly, I think there's a chance that we probably need to maybe get up into here before it can go down. And again, I don't know for sure, but it just feels like we're kind of in no man's land if you look at this kind of big channel that we're in. So and when in doubt, there's old adage, you don't want to short a dull market. I don't know if this market's dull, but what it means is if you want to be, you need some bad breaks to be short. Like look at this, a bad break, close on the low. S&P's down almost 5% that day. Very next day, it's down another 6. See here, like look at see, this is a bad reversal right here, below the moving average too. So you'll know. I think you'll know if you go back to like really bad bear markets. The look at the bars. Look how wide these bars are. I mean, the S&P's down 2.5% almost every other day. 2.5%, almost 3%, almost 3%. So the bars just get a little bit wider. Even the blue ones do too, but the ones we're more worried about are the pink ones. So I think you'll know when it's time to be a little bit more cautious, and I'm just not sure we're there yet. Let's look at the NASDAQ. Kind of the same thing. So you've got this kind of channel for whatever it's worth, and maybe once you come out of that, maybe that's how you'd want to. If you're long, maybe if it really gets going out of it, maybe you do some selling into it, and then if it breaks below here, that's what your kind of protective stop area. Gold. Let's look at gold. Is acting great. Oops, I must have that stupid show fund ownership on. All right. Coming out of this base here. I don't own gold. It's finally worked really well. If you look like some of the gold stocks, like sand, I think Newmont is one of the best performers in the S&P 500 this year. But it just kind of wore me out. I'd try it for years and years. I maybe made a penny in there, but nothing like what's going on. So I don't know what the story gold is telling. From a macro standpoint, you got bonds are saying that the Fed's going to cut rates. What does that mean? Means they're going to cut rates. What does that mean for stocks? I don't know. Let's find out. Let's see what happens. As hard as it is to believe, historically, the market does better when the Fed is raising rates versus cutting rates. The reason they're usually cutting rates is because something's wrong with the economy, and so if there's something wrong with the economy, then the market's probably going down in anticipation of that. So it's kind of counterintuitive. Everybody's running around hoping that the Fed cuts rates, but the be careful what you wish for adage kind of comes to mind. So if you go to TLT, from when it made like a new low here in March of 2022, like that's really bad interest rate action, right? So but what did the market do? March, it went down and then started a new bull market. Bonds did nothing. So that's probably why I think Mike Webster would say, Bill never mentioned bonds. He never looked at like the bond market. Like, what's the bond market doing today, guys? Wasn't really anything he was concerned with. So I just don't have a lot of feedback for the overall market. The nice thing is you don't have to trade the overall market. You can trade individual stocks if you want, or ETFs. And so that's kind of where I'm focusing most of my attention. All right, good trade, bad trade. I've got this one marked up. I thought, oh, I'll use this one. It's perfect. So this was Verta VRT in 2023. Stock gaps up through the base at 1788. I it just had no idea. I had never heard of this company. Couldn't point to it on a map in a million years. I knew nothing about it. But this is what screening and staying on top of the market and looking every week will do for you. All of a sudden, this stock started showing up on my screens from a relative strength standpoint. And across the bottom at that moment, you could see earnings were up 400% last quarter and revenue up 32%. So the time I'm buying it, you don't have the last quarter that you see here, but I did have 15, 600, 400 earnings and 21, 17, 32 across the bottom as far as sales. I believe, I don't know if my memory is fuzzy, but at one point, Druckenmiller had a position in this as well. I don't remember if that was one of the catalysts for me going into this name as well. It could have been, or would have been, if that was the case. So on June 5, I initiate my position at roughly 20. On June 6th, I had at 2031. On June 8th, I had at 2060. And June 9th, I had at 2110. How much? It's sometimes it can be like, let's say I wanted 2,000 shares. I might buy 700 on June 5. I might buy 300 on June 6th. I might buy 800 on June 8th, and I might buy 100 or 200 on June 9th. It's kind of random. It's a little bit like from the Nicholas Darvis approach. But the key is that every price should be higher than the previous purchase. I might buy more shares because maybe I'm getting more conviction on the name, or maybe other things are starting to work, or, there could be a lot of reasons why I want to ramp up the position. So it's not necessarily, 50, 30, 20 approach like IBD teaches traditional wise. Not that there's anything wrong with that way. Every strategy, everything pretty much in life has a yin and a yang. So the nice thing about the 50, 30, 20 approach is, you're protecting your average cost a little bit by adding less shares on the way up. But it's harder to really concentrate, especially if you're just a little bit uncertain, and so a lot of times people are uncertain. Like I said, I didn't know this name. I just buying it based on the chart and the earnings and sales. So sometimes that first purchase is the toughest one for a lot of people. So what I would say is just get something. Let's say you want to buy 1,000 shares, buy 200. Now you have something. And if it starts to go up, buy 300. And then if it starts to go up, buy another 500 to get you to 1,000. So just get in there. I think that first purchase is key. Stock runs up, and then at a handful of days later, I sell about a quarter of it, 25% of it at 2403. It's kind of what I do. I tend to sell on the way up because I'm concentrated. This might be a 20% position. So if a 20% position moves, let's say I'm up 3.5, 20.5, I'm up about 17%. So, roughly, 3.5, 3.25% move on my whole account, barring other stocks being equal. And I'm going to own this across all my accounts. Every IRA I have, every wife's IRA, every kid's Coverdale, every 401k brokerage account. I'm going to own all of this. So in essence, they're not all going to be the same percentage position, but in essence, my whole liquid net worth might move 2 or 3% from this name. And I just have a hard time not wanting to take the whole thing, to be honest with you. But what I've been trying to do, get better at, is just taking a little bit, relieve that pressure to take some off. So the stock didn't go down; it ran up, and then you can see it kind of pops out of this little mini shelf here, and I added at 26.42. So even though I'd sold at 24.03, I have no problem adding at 26.42, a mile away on the way up. I did not realize that earnings were the next day. So I just kind of got lucky in that regard. But to be honest with you, it wouldn't have mattered. I tend to hold through earnings, and it wasn't that big an ad. If I had 2,000 shares in an account, I think I bought like 400 shares that day or something like that. I was just buying it based on the chart and the price action. It was right near the end of the day too, so I didn't really have time to become aware of the earnings. But again, I would not have done anything differently if I had known the earnings were coming, because I think the only way to have a big winner is you got to hold through earnings. So it caps up on earnings the next day, and I closed the position. That was a mistake. I should not have done that. I should have, again, maybe sell 25% of it. But I just, the change from one day to the next, it's up 40% roughly. And if you have, let's say 25% of your net worth in there, do the math. It's a big move in a single day. And it just, sometimes the raw dollar amount influences me, and I lost my mind a little bit. So, but then can go back to it. But this stock's a lot higher now, and it went a lot higher. So you see how 35 really wasn't a good sell at all. I could have got back in, and somewhere along the lines, I do get back into the trade. But it's probably, I should have done maybe a 25% sell. Keep some along the way. It's easier to add. Once you get out of it completely, you're back at a brand new whole trade, and it's psychologically a little tougher. So this was a very good stock for me this year, that year in 2023. All right, so here's a bad trade. So here's Advantest. It's a Japanese semiconductor stock, coming out of this, popping up the 50-day right there, that blue mark. I bought the stock at 86. I got stopped out the next week. That's fine. I have no problem with that. It's just, it built another double bottom. It turned out to be a shakeout. I lost track of the stock. I missed the double bottom, and the stock runs from 80 to 160 in 1, 2, 3, 4, 5, 6, about 8 weeks. Now that's a double in 8 weeks. I'll capture maybe 50% of that. So that's 50% in 8 weeks. So that's a big swing and a miss. So a bad trade could be a trade that you should have and would have taken based on your process, your system that you have, and you don't take it for whatever reason. In this case, I think I took the stock off my screen or something, and I just lost track of it. So that was a big swing and a miss, because that was money that I definitely left on the table in that name. Okay, so let's look at some stocks to watch. And so let's look at some of the big boys like NVIDIA. I am short NVIDIA, but with an inverse ETF. It's more like it felt like it was allowing me to stay long some stuff and wasn't really hurting me. Now today it made I think it's getting hurt a little bit, maybe on the Avago Broadcom news. I always want to call it Avago because of the ticker, but they made some statements in the earnings conference call about chips that maybe they were making some headway against NVIDIA. So NVIDIA looks tired. It's made an incredible move. I heard a story a few days ago from a friend of mine who knows a girl that She bought the stock in high school because her grandfather told her to, and she's retired now from the stock. And it was he didn't know how old she was, but it's not like she was 50 or something. She was like in her late 30s or something like that. So it's just made an incredible, incredible move. Been probably one of the great, if not the greatest, stock market success stories in history. I was looking at um, the percentage of millionaires that work in NVIDIA is 80%. So pretty much everybody that works at NVIDIA is a millionaire. Now, being a millionaire nowadays, I don't want to downplay it. It was kind of a dream as a kid, right? I want to be a millionaire, right? When you're a kid, but inflation adjusted, I get it. Being a millionaire is not like it once used to be, but still it is a lot of money. And so 80% of them are millionaires. Half of them, half of the employees at NVIDIA are worth 25 million or more. Now, does that mean they stop working, they stop innovating, they stop doing this, they stop doing that? No, a lot of people work that make a lot of money still. Bezos has worked for a while. Zuckerberg still works, one of the richest guys in the world. So it can be very fulfilling to work. It doesn't mean you just because you have a bunch of money that you just have to stop working. If you like what you're doing, and I bet a lot of them like working there, I've heard it's an incredible place to work. Being worth 25 doesn't mean you have to stop, but it does mean that you could stop if you wanted. So it just says the main message is trying to say is this incredible amount of wealth that stock has created. It's made an incredible move. And I just, my 2 cents is the heart's out of the melon. I just don't think you're going to get rich buying NVIDIA going forward. Now, could you make some money? Could it go up? And so on and so forth. Yeah, it could. And, I think I bought it there maybe. And, I just couldn't help myself, maybe sold it there. But, went from 140 to 180. It's a huge move. It's a really good move if I'd been a little bit more patient. 28%. So I just feel like the heart's out of the melon NVIDIA. It's a market stock, in my humble opinion. I would avoid it. If you're looking for outperformance, I think NVIDIA is an avoid. If you own it already, no problem. Keep it, do whatever you want. Don't listen to me because I'd have had you out a long time ago. Apple, I don't know what to make of Apple. I don't even look at it, to be honest. I didn't know it was acting so much better. A market stock, an avoid. Amazon, I just think these stocks are avoids. I think if you're looking for, I'm not saying you're looking for the next Google, next Amazon, next NVIDIA, but these stocks have made such a tremendous move. Microsoft, I don't know why it's getting hit like that today. I am short Microsoft as well with those inverse ETFs. Again, it helps me to be a little bit long. And it's Microsoft. I'm not going to get rich being shorted, but it offsets a little bit of the volatility that it helps me to sit a little bit better. When my account's moving around in raw dollars, that's usually where I make mistakes. So what I'm trying to do is just offset that. So let's say I'm getting killed in 5 names. Hopefully the Microsoft and NVIDIA ETF is cushioning that blow a little bit, and so it helps me to sit a little bit and be more patient. It's just a psychological thing. I don't know if it's all that great a strategy, but if it works for me, then I'm going to keep doing it. Some of these stocks like SanDisk, wow, look at the move there. SanDisk, Western Digital, and STX. Just incredible moves. Now, the lesson here, I think, for me, let me turn the pattern rack on, is when you see a stock start to do this and it just doesn't want to go down, it doesn't want to build a base, you just have to kind of find a way to get into it. Just get in. If you want 1,000 shares, just go buy 200. There's the same thing I've talked about a million times. Because otherwise, what happened with Seagate was, I think Druckenmiller had a position, and it just kept waiting for a place to buy it. And I'm still waiting. So the best stocks, they're just not going to give you a chance sometimes. So you just kind of have to hold your nose, so to speak, and buy it. I guess Western Digital, now this isn't a flat base. but that's a little bit quasi flat base, not long enough to be a flat base, but that could have been bought there. SanDisk, again, I don't know if what this is partly why sometimes I keep the pattern rec off on one of the time frames, because I think that is a big double coupled handle. Or if you say, Scott, that's not a coupled handle, I would say if you gave me this chart in 1999, I would have said, oh, that's a coupled handle. That's a buy at 48.46, and I would have I would have known none the better. The number of days long it was, I wouldn't have even known, oh, that's not long enough. I wouldn't have even thought of that. I'd say that's a coupled handle, buy that. And so I'd be in it, maybe. No, honestly, I probably would have sold some, if not all of it there. But that's partly why I don't put too much emphasis on the pattern. It's more on stock acting good, it's in the right group. Is there ownership? I don't know if there's any ownership in SanDisk, but you can see that funds have gone from 500 to 619. I think I don't know if Jim Ropel owns it, but I saw him tweeting about it. So this is an area that's now it's gone. It's gone. This group is gone. Now, can SanDisk go higher? Sure. Can Western Digital go higher? Sure. But it's gone, I think, from the traditional standpoint. And so it's okay. Well, how do I not mess that up the next time? What do I do if I see something doing that? Just relentless, grinding higher, doesn't want to go down. CLS is a good example. I think I bought CLS. Let me turn this off again. Sorry. Here, somewhere in here, I bought CLS because it just didn't want to go down. Now, to me, the buy point was this double bottom. That was a buy point, but I was kind of asleep at the wheel and bought it up there. And you can see what a tremendous move this one has made too. So this whole group is, I don't know if this is in the same group as CLS, TTMI. Yeah. A little bit thinner. There's another one. It's done really well. There's the buy point, but maybe it wasn't on your radar. Maybe you have to buy it there. Energy, you've got Talon. Now, this seems, everybody and their mother now knows that energy is the place to play, is the way to play AI now. So I'm a little bit hesitant on this group, but this stock sure is acting well, holding up. Let's see what VST looks like. It's okay. Let's look at VRT. It's just okay. So let's jump to like crypto. So MicroStrategy, I don't know. It just looks like a non-event to me. Here's the Ethereum up ETF. Looks like I just don't know how you would play that. Let's look at coin. Little reversal day. Let's look at IBIT. It looks okay. So the whole crypto thing, I don't know. Maybe it just needs to rest. What else is out there that Chinese stocks, we can look at those. So BABA, the report wasn't all that great, but the price action in the stock was really great. So it was up 13% this day. I bought BABA that day. And then this day, you had the Chinese government come out and kind of quash the rally in Chinese stocks, which I'll never understand that. I mean, it's been in a bear market for 15, 20 years. Can it go up? Give it a chance to go up. But they made some negative comments. The stock got hit really hard. And I just kind of lost my ump for it and just said, uncle, just sold it. And then today, here I am trying to start back a position. I just don't know what to do with Chinese stocks. They're just so tough. I'm torn because I feel like, look, it's been in a bear market for a long, long time. And let's pull up like the ETF, KWAB, been a bear market for a long, long time. But this looks pretty good. This looks to me like going higher. I just don't know how to play it. Futu, I thought it was going to 200, and it got there very close today. I sold Futu today on the gap up in the morning. So I like this one. If you look at the weekly, it looks fine. I would like maybe catch up here, something like that. Look at that earnings line. I mean, it's just so strong. Tiger was another one I sold this morning on the gap up. I like Futu better. Just it feels like more institutional quality. Not acting that well today. Um, so I just don't have the answer for Chinese stocks. It's really a tough area. You've got so many. I just when I just look at the chart, my instincts are higher, a lot higher. Today, tomorrow, next week, no, I don't know. 6, 9, 12 months, I feel like a lot higher. So that's why I'm navigating towards, or gravitating is the right word, towards them. All right, let's move on to the quote of the week. Tom Howgard, he was on a podcast, I think it was. I just stumbled upon him on YouTube because I've watched other videos that he's done. He wrote The Best Loser Wins, which I like, is a really good book. And he said, I have come to the conclusion that the reason why the vast majority of people don't achieve success, he's talking about the market success, of course, it's not because of their lack of knowledge. Rather, it is the inability to act upon the knowledge that they do have. So pretty much everyone knows the rules. The rules are fairly simple. I think there's like 3 or 4 rules that are 200 years old. Even like is it the economist David Ricardo, maybe 400 years ago, where he talked about basically writing your winners and cutting your losers. It's that simple. It really is. Ride winners, cut losers, short, uh, you know, manage your money, trade along the trend, the line of least resistance. There isn't that much more to it. I don't believe. I think it's all right here. It's all in your head. It's all between your ears on being able to do that. And that's really where a lot of people spend all their time studying, the 1984 stock market and the little wiggles and waggles. And uh, fine, it's great, but I'm not sure how valuable that is when you think about like studying yourself. Now, if you have the time to do both, awesome. It's fun. I like to look at old stocks. I have a bunch of model books, and sometimes I'll go through them, and it's just I think it's more inspirational to see like how many stocks went up 100, 200, 300, 400%. There just hundreds of them, thousands of them. So they're out there. You just got to find them and hold on to them and handle them right. And that's right here. It's between the ears, I think. It's not about reading the chart correctly. So you guys, 90% of you watching this video have the knowledge to succeed in the stock market. I don't know what percentage have the ability to act upon that, to be honest with you. And I'm in that camp. Sometimes I fall off the wagon. No, I very few people have the stock market knowledge that I have, and I don't say that to be um like a humble brag, but I have 35 years just immersing myself in this. So that's not the answer, because sometimes I will not act upon that knowledge that I have. I'll make a mistake. I won't cut the loss too soon, or like VRT. I know that that's not the time to sell that stock. It's just getting started, probably. They've announced a huge quarter. The institutions are reevaluating their models of where this company can go, and they're probably changing their price targets from 50 to 200. And I'm selling into that at the very beginning. That's not the right way. So it's execution, courage, patience, imagination / vision, and last but not least, probably most important and easily to me, I think the hardest part is execution. So just try to get better at that, slowly but surely. 1% better every day, every week, every month, compounds on itself. All right, 800-831-2525, Marcus Surge at investors.com. Have a great weekend, everybody. I will be back next Friday. So there will be another video next Friday. See you then. Bye bye.